As if a decision on interest rates weren't enough, tomorrow in Washington, the CEOs of the nation's biggest banks will be on Capitol Hill in front of the House Financial Services Committee. J.P. Morgan's Jamie Dimon, Citi's Jane Fraser, Bank of America's Brian Moynihan, Wells Fargo's Charlie Scharf, all there to talk about the economy, their hiring practices, and much more. Here to tell us what they are expected to say, CNBC's Leslie Pickert. Les.
Hey, Mel. Yeah, the title of the hearing is, quote, Holding Mega Banks Accountable, Oversight of America's Largest Consumer-Facing Banks. The Financial Services Committee majority staff say they're looking for the CEOs to address a variety of issues, including consumer protection, compliance, enforcement actions, diversity and inclusion, and emerging technologies in the banking system. In their prepared testimonies disclosed today, the CEOs largely addressed these topics, many of them touting the role they played during the pandemic, processing PPP loans, waiving or lowering overdraft fees, and raising the minimum wages of their employees. They addressed what they're doing to promote diversity and sustainability within their organizations and the controls they have in place from a cybersecurity standpoint and a privacy standpoint. Now, while the hearings were called with a focus on consumer-oriented products, sources close to the CEOs and lawmakers expect the line of questioning will actually wade into other areas as well: ESG, environmental, social governance, and the polarization of those three letters is expected to be topical tomorrow, as will the regulatory environment and the overall health of the economy, how consumers and businesses are faring in the face of inflation. The hearings will be hybrid format and kick off tomorrow in the House before another one with a pretty similar topic in the Senate on Thursday. Mel.
They're going to deliver prepared remarks, Leslie. Do we have an idea of what's in those remarks?
Yeah. So all of the remarks have been posted on the House Financial Services Committee website. I've read through all of them at this point in time. They all basically address those key points that the House was looking for them to hit on, kind of their role within the economy, their role within, making sure that their employees are paid well, there's diversity in their workforce, what they're doing with regard to sustainability. Interestingly, the House Financial Services Committee did address topics related to abortion and some of the bank's policies to pay for travel for their employees, but that didn't make it into any of the remarks that I saw with regard to the policy specifically related to abortion. But other social issues were largely addressed as it pertained to their workforce.
Leslie, thank you. Leslie Picker. I think what the hearings are called is sort of key to understanding what the gist of this is. Holding mega banks accountable. It sounds like they have a target on their backs, Tim.
Yeah, I don't even want to touch abortion on this one. So I'll just say, when I look at banks and I look at what they might be there to talk about that I would want to listen to, I listen to Jamie Dimon, once again, the weatherman, and using the metaphorical storm clouds dynamic. And he's pointing out a couple of things. He's pointing out some of the health, the consumer balance sheet, the dynamics that are quite healthy, a robust labor market, all the things that we talk about on this show, and then also talking about the dynamics that he sees on the horizon. It's very interesting. Banks have actually outperformed the market. And look, we do this all the time. You can pick different places in the road off of essentially their greatest period of underperformance going into that period where the S&P actually rallied in the summer. Banks really underperformed since that point, and as rates have shot higher, banks have outperformed the S&P by about 12%. If you look at them year over year, they're pretty much in line with the S&P. They've underperformed by 200 or 300 basis points. Banks have, I think, still never been healthier. Bank loans are a place you start to worry about what's going on. Credit hasn't really happened yet. So we always, Dan talks about this all the time. To what extent are we pricing in credit dynamics that we just haven't seen?
Right. And yet capital requirements are higher
Never
now.
higher. And they say that that's a risk to them.
Right. I mean, J.P. Morgan, they had to suspend their buyback in July because of higher capital requirements. That is going to come up, to be sure.
It is interesting, and Jamie Dimon's prepared remarks actually specifically spoke to that. It is interesting how poorly J.P. Morgan acts relative to Bank America and Wells Fargo off of its lows. Wells acts really well, up about 20%. Bank America up about 15%. And then obviously, the investment banks, Morgan Stanley and Goldman, despite the fact that we know a lot of the activity that they traffic in, they are not the mega banks, are not doing particularly well right now. They act really well off of the lows. So there is some, to Tim's point, some decent relative strength other than J.P. Morgan right now.
Is there another shoe to drop, Julie, for the banks in terms of credit deterioration and loans that aren't paid back, et cetera? Or have they just they made loans in a smarter fashion this time around, and so the banks are strong?
I think that's a question of stay tuned to find out, right? It's hard to know the quality of the loan book, but we do know that in a rising rate environment, that's going to stress their borrowers, be it on the consumer side, but also commercial loans, all of their private loans. So I think there's for sure going to be risk to that. And you saw them making initial contributions to prepare themselves for that and for potential loan losses. But, the level of increases on variable rates it's going to be substantial. And so, I think longer term, the good news is that they're much better capitalized. So I don't think we're going to hopefully have anything resembling a financial crisis, but I still think that they are liable to see some regulatory challenges because just the tone of regulators and those on Capitol Hill is not very positive towards them.